Central Bank of Kenya has sustained its push for the scrapping of interest rate caps in the country, even as Parliament fights to have the rate caps stay. Victor Kiprop now puts into perspective the future of the law, which was recently declared unconstitutional by the High Court.
Just 2 weeks after the High Court suspended and gave Parliament 12 months to amend the interest rates control law, which it said was ambiguous, the Central Bank of Kenya says it is determined to ensure that the law does not come back to life.
We are working with the commercial banks to make sure that we won't go back to the old regime that got us here. The caps obviously have, in a sense, destroyed a lot of our parts of the economy. And what we need to do is to go back to a better organized banking sector that actually is much more customer-centric.
Part of the solutions the CBK hopes will guide a successful return to a free-floating interest rates regime is the draft Kenya Banking Charter, which emphasizes on transparency and the use of a risk-based credit score to issue loans. CBK's quest, however, faces challenges from an appeal lodged by the Consumers Federation of Kenya (COFEK) and lawmakers, some of whom have already vowed to retain the cap.
It's a journey. We started on that journey. We started it some time ago, but we are hopeful that we will actually have a solution that works for Kenya, for Kenyans, and indeed provides the opportunities that we all want.
Kenya introduced interest rate caps in September 2016 in order to reduce the cost of credit. But the cap has instead stifled credit to small and medium enterprises as banks hoped for risk-free government securities, according to the Central Bank of Kenya. Victor Kiprop, NTV Business.